All right, everyone. Welcome back to Financial Clarity for Doctors. I'm Corey Janoff, joined as always by Rochelle Vanderzanden.
Hey, everybody.
And today we have a special guest, Casey McLaughlin. Say hi, Casey.
Hello.
Casey is a mortgage loan officer with US Bank, and today we wanted to bring Casey on to talk about physician mortgage loans. And full disclosure, Casey has worked directly with me and some of my clients all over the country. I know he's done a decent job for a number of people, probably some of you listeners as well. And US Bank, they're able to lend in all 50 states except New York, which is convenient if I need to refer a lender to someone. It's a pretty easy, they can likely do it where you live. But there's a number of mortgage companies out there that do physician loan programs. A number of them are regional. So depending on where you live, there may be some others that can offer some competitive products for you. But excited to have Casey on to talk about physician mortgage loans, pros and cons, how they differ from conventional loans, and really give you some insight into that if it makes sense for you to pursue for your next or possibly first mortgage. So thanks for joining us, Casey.
Yeah, appreciate the opportunity.
Absolutely.
Casey, could you start just by telling us a little bit about doctor mortgage loans or physician home loans and how they differ from more conventional loans for people like Corey and I?
Yeah, no, absolutely. And yeah, when I first started, I didn't even know that there was such a thing, right? And as I started to get into the world of lending, I found one of my peers were like, "Well, yeah, you can do a physician loan," and I thought, "Well, what is that?" And basically come to find out that physician loan is for medical doctors, specifically MDs and DOs, and the biggest thing is it doesn't require mortgage insurance for a lower down payment. Now that lower down payment can vary, anywhere from some lenders that may do 0% up to other lenders that, they do 10%. I can say specifically US Bank, we offer that 10% down. That's the lowest down payment. But yeah, I mean, that's it. It just can be a big game changer for clients that just may not have that big down payment available, but they have the income, to support that payment. So yeah, it's a interesting a product that I've been able to, like Corey said, help a lot of clients with. So
So what exactly is the mortgage insurance, and is there a typical cost for that? And
yeah, and you'll have to forgive me. I have a few notes in front of me. So I mean, as far as the mortgage insurance, uh, you know, it depends on the loan amount, right? So the rate really can depend on it can range anywhere from like a 0.5% to up to 5% of the original loan amount. So it is going to vary. You know, if it's a smaller loan, obviously smaller amount; bigger loan, bigger amount. An example I could give you is, if the borrower borrowed 150,000, which, hey, that's not realistic these days, but they borrowed 150,000 and the annual premium cost 1%, the borrower would pay $1,500 each year or $125 per month. So again, as the loan amount gets higher, yeah, that premium is going to be higher. And essentially, it's there to protect the lender if the borrower was to essentially default on that loan payment, right? So it's just like any insurance; it just protects an individual or a
and is that
company.
like something that's pretty much just automatic if you're putting a non-doctor putting less than 20% down, they're almost certainly going to have mortgage insurance? Is that right?
There is, but there's actually on the if we're not talking about the physician loan, there is what you might hear of the term lender paid mortgage insurance. So if you had a loan where maybe a rate was, let's say it was at a 4%, if they were paying mortgage insurance, maybe the lender paid mortgage insurance may be 4.5%, but there's actually no mortgage payment. So the lender needs to make up some of the difference, so they end up charging a little bit of a higher rate. So there is in the non physician loan world, there is an option, but you're typically going to pay for it.
You're paying
If
for
that
it
makes
one way
sense.
or another.
Exactly. Yeah. Yep.
Yeah.
Yeah.
So aside from being able to put less than 20% down and not having that private mortgage insurance, are there any other benefits for doctor loans or anything like that?
You know, I was kind of thinking about that question, and this is something where it would make more cash available for the borrower in the sense of, especially for some of your guys' clients, maybe making payments to cover student loan payments, right? So if they're trying to get that knocked out quicker, it frees up, more money that they may have on hand to get that out of the way. Or if they want to, invest for their future, it allows them to put more money away monthly for, that retirement when they finally reach it. So, that would be one thing. One of the other things that I learned early on too is that we can actually use a future employment contract. So, for example, if somebody's, let's say they're maybe they're 6 months, within 6 months of completing the residency, but they have obtained a contract with their employer, we can actually use that contract to qualify them. So they're going to have a lot lower income in the residency than they will in their future employment, right? And so as long as we get a signed contract by the employer, we can use that. We then just reach out and get a written verification of employment confirming that that contract is actually valid, right? Signed by manager and whatnot, and then yeah, we use that income. So um, that's not something that all borrowers are able to have access to. Um, and then this kind of goes in combination with this, but also you're able to then close early or when I say close early, um, if let's say for example somebody's moving across country out to Oregon, which where we're located, and they want to close 60 days before they're starting their job, we are actually able to use um, that new employment to allow them to close, get out here, move into the house, even though their job hadn't fully started yet. That makes sense.
Yeah, that's really cool.
Yeah.
So yeah, definitely some advantages there. Being able to use future income for residence fellows. Rochelle and I'll say there's obviously some risk to that. If the job falls through, you're still on the hook for the mortgage. But for a lot of you, it's a nice perk there for sure. And then in terms of like if you're putting less down, doing a physician loan, if you pursue one of the doctor loans, are the fees and the interest rates going to be different than if they did a conventional loan, or is it pretty much the same?
For us, the fees are straight across the board. Um, the only fluctuation in the closing cost fee. So we're talking about appraisal, the origination fee. The titles are going to vary. The title fees are going to vary depending on your loan amount, right? But that doesn't really matter lender to lender. Um, but what can vary is sometimes the rates. I actually was curious on where that was, and today before we started our call, I did look, and surprisingly enough, and it's usually flipped, and it just depends on where we are with uh, stuff going on in the world and whatnot. But our physician loan rate was actually lower today by almost a quarter of a point, which usually it's flipped. Right. But it's just one of those where our physician loans we hold on to as a company, which we would call, our portfolio. And so we have a little bit more control over how we price the loans. But historically they're either very similar or just a little bit higher for the physician loans. So um, yeah.
Can you talk about that briefly, like the portfolio loan versus a conforming loan, like with the difference between the two there, like one that you'd sell out to a Fannie or Freddie or something?
Yeah. So like you were saying, with a conforming loan, basically at the end of the day, when the loan is fully funded and closed, within a month or two, that loan actually gets sold to Freddie Mac and Fannie Mae. And so, from a servicing standpoint, though, that's one thing with U.S. Bank. We do not sell the servicing, so we actually hold on to that loan for the whole life. Now, with the portfolio loan that you're asking, that is something where it stays on our books. So we, we underwrite it, we process it, we close it, and then that always stays with us. So it's never, might hear people say, oh, I got my loan sold 3 different times, within the first year. Well, we don't do that with our portfolio loans too. And one of the other differences is there is a couple additional requirements as far as with the portfolio loans where you might hear a reserve requirement. So for example, if let's say your payment was $2,000 a month and your loan was under a million, we would say, oh, okay, well, we need to have 6 months worth of reserves. So that would be $12,000, right? On the conventional side with the Freddie and Fannie, as long as it's a primary residence, there's no reserves requirements. So the good thing to know about that though too is some people say, well, I don't have an extra $12,000. You can use any type of retirement accounts, investment accounts if needed. On the retirement account, it can only be 70% of the retirement dollar amount, but it's just it's a good thing to know because some people, especially if they're coming right out of their residency, they may have put some away, but it may not be a super large amount, but maybe they were able to put money away for the retirement, right? So hopefully that answers that question.
Yeah. So like the
That is
conforming
something we
one.
come across a lot.
Go
Yeah.
ahead.
I was just going to say that is something we come across a lot with clients where they expect, like, if they're going to do a 0% physician home loan, they can come to the table with nothing. And that's a common misconception I feel like people have. It's like the bank wants to see that you can make your mortgage payment. There are going to be closing costs. Like, there's all these different things that, require some amount of cash, or like you said, Casey, retirement reserves or something like that to demonstrate that there's some money available.
Yeah. Now, one thing I didn't mention though too, that's a good thing to know is you say, well, yes, you need to come to the table with something. A lot of times you're able to get gifted funds though too. So if you're fortunate
Mm-hmm.
to have a family member that would be willing to gift you some of those funds can be used for down payment, closing costs, the reserves requirement, really anything. So that's definitely something uh, that can happen. And I'm pretty sure I've done that with some of the clients you Affinity Group has referred to me. I think there's been a couple uh, individuals that were fortunate enough to have that be able to be an option. So that I'm kind of glad you brought up that point because I forgot about the gift funds piece.
Are
Mm-hmm.
there any drawbacks to doing a doctor loan over a conventional loan? And if so, what are they?
Well, I kind of already touched base on one a little bit earlier, just more talking about if it's a lower down payment, than that 10% that we offer. I would say kind of like potential losses. And what I mean by that is I actually found a statistic that was saying that 12.4% of second and third year doctors leave their practice um, for a new job, right?
That
And
seems
so if
low to me, honestly.
and maybe it's higher. I mean, that's just a quote that I found. But I mean, essentially, if you're forced to then have to sell in a bad market, and you only put either 0% or 5%, and even 10%, um, you might have to if write a check to get out of it. So I mean, that's one of the things that could be a negative. Um, and again, I keep beating it up with it, but the comment about yeah, if you only have 5 or 10% and you just don't like the house, maybe it's not even a job situation. Um, yeah, it just can be a situation that you could get in trouble with putting such a low down payment out. Now that could happen with putting 20% down too, right? I mean, it's been such an appreciating market for most of the U.S. over the last what 5 years. Um, but yeah, it's always a gamble that you take. But I mean, other than that, we had touched base. Usually it could be the interest rate would be a tad bit higher in a physician loan. It just really kind of depends on the times, because, like I said, historically ours have always been a little bit higher for the physician loan, but as of today, they're different. Um, but other than that, to be honest, I can't really think of any. I mean, it's a pretty solid option for those fit doctors out there.
Yeah, a lot of the risks that we talk about our clients with, it's not like they're specific to physician loans necessarily. It's just if you put a low down payment down, you probably don't have very much equity, and that's an issue if you're going to sell, whether it's a physician home loan or not. So yeah, lots of things to consider when you're moving and getting settled, and you want to pencil in some wiggle room for uncertainty in your job situation and everything like that too.
I mean, just do the basic math. If you put 5% down and then you need to sell your home and pay a real estate agent 6% to sell it, you're already at -1%, and that doesn't even include any of the closing fees and costs to spruce up your home to get ready to sell it, moving expenses, things like that. So now if your home appreciates in value, it might all work out. But if your home goes down in value, which we've seen happen before in history, um, if anyone's lived through the early to mid 2000s and owned a home, they know real estate doesn't always go up in value. So there are some drawbacks to putting less of a down payment for sure.
Yep. And even if you put down 20%, it's not like you didn't lose that money. It's just that you didn't have to come out of come up with it out of pocket to get out of the house. Like you still lost that money in terms of like how much equity you were able to pull out of it. But, yeah. Casey, when people are looking around for mortgages, how do you suggest that they approach shopping the market to get the best deal for their circumstances?
Yeah, when I was reviewing these questions, this is one I really liked because I think it's important in my opinion, just really three main things. Um, the one I wanted to start it off with is to say, really make sure you're confident with the loan officer that you're working with. Right? I think some people just get so focused on, oh my gosh, this is the best rate. And at the end of the day, yes, of course, we want to make sure we're getting, the rate that's going to be the best for us. But I just had a couple horror stories where somebody's worked, and I'm not going to name any names, but some companies where they've just started out and it's supposed to be a week before closing. All of a sudden they're like, oh, whoops, actually we can't do this. So having somebody that's experienced, that knows what they're doing, and that you honestly just have a good feeling about too. And most of us, I feel like, can figure that out in the first couple minutes that we're talking with somebody, right? Or is this just a salesperson that's just trying to get my business, or do they truly understand my picture and understand what I want and whatnot? So I think that, to be honest, that's probably the biggest piece. But as I touched on just a second ago, I mean, yeah, rate shop, right? Um, you want to make sure you're getting the best deal out there. And honestly, if there's a company that you're like, I 100% want to go with, ABC Mortgage, but maybe mortgage.com has a better rate. What I can tell you is all mortgage companies are out there to compete, right? So if you find out that mortgage.com actually has a lower rate, get a loan estimate from them and go back to ABC Mortgage and say, hey, I got this rate from mortgage.com. Can you guys match it? And I would say 9 times out of 10, they're gonna match it, right? Because at the end of the day, they want your business. So make sure you're shopping, don't just go to one lender. And I'm incredibly loyal to US Bank. I've been a customer since I was like 10 days old. Right? My mom opened a savings account for me, and I've had it since, right? So I did my mortgage with US Bank, but my wife had an account at Rivermark, and so I was like, let's go and see if they can offer something better. And uh, end of the day, US Bank was the better option, but you never know unless you reach out to try to see if they can offer something better, right?
I like that you mentioned the rate isn't the only thing. Like you said, it's helpful to have an experienced loan officer. It's also, I think, an underrated component to have a loan officer and a real estate agent that are on the same page and communicate well so that things get done in time for closing. And then also on the rate side of things, like it's not like US Bank has one rate, Bank of America has another rate, ABC Mortgage has another rate. Like there's a sliding scale. Like, can you talk about either getting credits back for going with a higher rate or paying extra upfront to buying down and getting a potentially lower rate?
Sure. Yeah. So like you said, I mean, we use the term par pricing, right? So par is going to mean, hey, the borrower's not paying any money for the rate, and the bank's essentially not giving we use the term concession. They're not giving up, any, I guess you could say, earnings, right, for giving that rate. And so we usually look to do that par pricing. But again, if let's say, again, that client goes to mortgage.com and says, hey, we, instead of 5%, we'll give you 4.875, right? So that would be something where it's just more of a competitive match. But if the borrower wasn't able to find any better option, and they want to, let's just use as an example, hypothetical example, rates at 4.875, they might say, well, how can I get down to the next lowest rate? Typically it's an eighth of a percentage, so you'd go down to 4.75, and I might say, okay, that's going to cost you 1 point. People go, what the heck, what does that mean? What does a point mean, right? So as an example, let's say a loan was for $400,000. 1 point would equate to $4,000, right? So you would then say, okay, well, does that make any sense for me to do it? And I'm gonna have to pull out my phone here real quick from the math. But let's say that the difference in the payment from 4.875 to 4.75 is, let's say, $75. Okay, so if you divide 4,000 by 75, your break even point's 53 months. So that's 4.4 years. Probably not going to make a whole lot of sense to do that unless they're just saying, yep, 100%, this is my house, I'm going to be here for 30 years, right? I mean, as we all know, in 2 years, a lot of stuff can change. And so that's usually my kind of breaking point as far as where I feel like the client probably shouldn't pay for it. But yeah, I mean, if it was 8 months to break even, no brainer, in my opinion, right? Because then you're starting to pay less in interest um, for buying down that rate.
And I've had
So
scenarios where clients are shopping multiple banks and they'll send me two proposals. One has a lower rate but higher upfront costs. The other has lower upfront costs but a higher rate. And it's like, well, what makes the most sense? Well, if you don't foresee yourself in this home long term, it might make sense to go at the higher rate but less out of pocket up front. Because when you do that break even analysis, you'll probably be out of the home, and you'd rather have the more money up front in your pocket. Whereas if you plan to be there long term, it could make sense to put more up front out of your pocket in order to get that lower rate, because over the long run, the lower rate potentially could ultimately make more sense. But yeah, case by case,
yeah,
every circumstance is a little different.
yep. And let me answer the second part of that, because you were kind of talking about buying a rate, but then maybe a credit. So just an example of a customer recently where they were buying a home in Central Oregon, and they have a house here that they're going to be selling in the next year, right? And so he didn't really want to he wanted to minimize what he needed to bring in for his closing, right? And so again, just a hypothetical rate, if let's say his rate was going to be at 4% for par pricing, again where we talked about earlier, where it means you wouldn't, you're not paying anything. he I think he took a rate maybe of, let's say, 4.75, but it also gave him uh it was like 2.5 points of a credit, which was somewhere in the range of, in that scenario, it was like $15,000. So he ended up coming to the table with only his down payment, because he was then going to, in the next year, pay it off. And so he didn't have to really pay any money out of pocket. Right. So it really depends, like you just said, case by case scenario where credits may or may not make sense. One thing I can tell you with U.S. Bank specifically is, if you establish a checking account before closing, if your loan, you would get a 0.25% credit of your loan amount and no more than $1,000. So almost every client that I work with would get some form of a credit just for basically establishing a relationship with us. And so that's just kind of a nice little perk for your clients to know if they did ever go with us. Now, if it's under 400,000, obviously it's not going to be that 1,000. Again, a 0.25% of whatever the loan amount is. But just thought I'd throw that out there as a little perk. But yeah, good lesson on points and credits.
There we go.
Casey, do you know how many times? I think this probably varies from bank to bank, But how many times can doctors generally use a doctor mortgage to finance a home purchase? Like, can they use it for a second home or even for a vacation home?
So, I can't speak, for everyone. Specifically for U.S. Bank, we only allow it for primary residences. But, you might have something where let's say you did a purchase with us, and then, you know, 2 years later, you decide that you want to move into uh, a new primary residence, right? You're still able to use that as many times as you need for a primary residence purchase. But when I say as many times as you need to give one actually added piece of information, we on our qualifications as far as who's eligible, again, it's the MDs and the DOs, and then you have to either be within 6 months of completing your residency or no more than 10 years out. So I shouldn't say you can use it forever, right? You can only use it essentially till 10 years out. um, and again, that might vary from lender to lender, but that's just U.S. Bank's guidelines. But I think it's a pretty standard guideline.
Yeah, I think that's pretty common. A lot of places, aren't going to let a doc 20 years in practice use their physician loan program because it's like, well, you've had 20 years at an attending level income. How come you haven't saved up more
Yeah,
money yet?
yeah, yeah.
What about refinancing? Are there any special like doctor loan refinancing perks? Like, typically you need the 20% down to do that too, or 20% equity. Are there any benefits or special doctor refinancing options?
So it's really the exact same requirement as far as the 10%. So if you had if you were at 84% loan to value, right, you're still not meeting that 20% requirement. But yeah, U.S. Bank basically will go up to a combined loan to value of 90% and be willing to refinance that. One thing that I think is very uncommon that people do not know about, though, when we're dealing with that refinance piece is you might hear the term a client does an 80-10-10, right? And what that means is the the first mortgage that they would have is they would go to an 80% loan amount, right? Then they would do whether it's a second position loan or a line of credit, right? That basically allowed them at that point to avoid the mortgage insurance, right? Because that first mortgage was the 80%, the second was just a standing line of credit, and then they put 10% down, right? You might think, well, okay, that's fine, but some of them, depending on where rates may be, they might want to try to combine those two, right? And a lot of people would think that that is considered to be what we call a cash out refinance. So in the world of where you're trying to um, doing your refinances, it could just be rate and term where, hey, my rate's at 4%. I want to get it to 3.75. I'm going to refinance my loans, restart my term. That's a rate and term, right? But if you're ever adding any uh, debt to the first mortgage balance, it's typically considered uh, a cash out, right? And okay, well, what does that mean? It's usually going to give you a higher rate, right? But with the physician loan, if somebody has that first and second mortgage, as long as they as long as they on the loan used it the to obtain the purchase of the home, or in a line of credit, if they haven't drawn on it for more than a year, those can be combined and treated as a rate and term refinance, right? So it's almost the same rate as you would have with a purchase. And so that's a great thing, especially for the lines of credit, right? Because on a second position mortgage, those are typically set rates. So you're not going to be as big of a trouble if rates start to adjust. But on a line of credit, they rate just went up last week by 1/4%. So that's going to increase your payment on that second position home equity line of credit. And they're talking about it going up, 4 or 5 more times this year. And typically that's an extra 1/4%. So it's something that can be an awesome opportunity to get those two combined into a fixed rate, and not being worried about, oh my gosh, is my payment going to go up $100 next time? Is it going to go up 50? So yeah, that was something that came to my mind when we were talking about the refinance piece that I think, like I said, a lot of people don't know. And I don't know that all lenders offer that, but that's something that I found out probably in the last 5 years. That first 2 years I was starting, I didn't even know it was an option. But it's an ever-changing world, just like for you guys and your world as well.
Absolutely. So switching gears a little bit, when we have new buyers coming to the table, sometimes they don't want to buy something that's available. They like want to build their own house. They want to do a custom house or new construction, and that can create problems sometimes with lending. Are there physician home loan options for that kind of a purchase?
So for the new construction, and I'm going to kind of break it down in two pieces. So when we're talking about new construction, hey, it's not going to be done, or say not be done, but I'm picking out what I want. They're going to build it. It's going to be 6 months, till it's done. Um, U.S. Bank actually has a construction loan product that we offer, right? Where you have to provide the bank the blueprints, you have to provide them the builder, they have to be part of our approved list. Um, that's not something that is part of the physician loan world, but in the construction loan world, we actually, and don't quote me on this, but I believe up to 650,000, you're only required to put 10% down, and there is no mortgage insurance. Biggest reason on that is because being that it's new construction, it's a little riskier. There's not a lot of private mortgage insurance companies out there that are going to want to take that on, right? So you typically are going to have a little bit of a higher rate than you normally would for just uh, a standard loan, right? But what you can do is after the fact, when it's finally completed, if the rate's advantageous, you can go back and refinance that construction loan down to a more favorable rate. But uh, so there is no physician loan products, but it's the same pay, same 10% down requirement, right? Um,
Well, I guess the refi at the end could be the physician loan version, right? Potentially, or
there you go. Yeah, I just need to do my job. Yeah, no, I didn't even think about that. But yeah, it's just not something I've really came across with that question. Um, but yeah, that's a great idea. But then there's the second piece that I was going to say where it might be something where you have found development, and the builder has all these houses available, and you're not necessarily having to get blueprints and all that available. They're like, hey, this is option one, this is option two, and again, hey, maybe it's not done for 6 months or whatnot. But in that type of a situation, that's where you would be able to use the physician loan, right? Because it's just a standard, it's a standard uh, purchase requirement where you're not needing to use the construction loan product that we have because it's being financed by the builder. In the construction part, essentially the bank is financing it. Does that make sense?
yeah, so like new development spec homes versus a custom build that you're
Exactly.
start. Yeah,
Yep,
that's
exactly. So, but again, I'll have to remember that about the new construction piece. So you taught me something today, Corey.
there we go. Yeah, I think most people that embark on those custom builds, they probably it's not usually their first home. They've got some money available, and they maybe have some equity in the home they're selling or something. So probably not super common where they're trying to do it with only 10% down. So,
Yeah,
plus if you have to buy the land for it too, I think there's some additional requirements for purchasing the land to begin with. Anyways, we're kind of getting off topic. What about like uh, tips for prospective home buyers to do ahead of time? What are some smart things and what are some no-nos to try and avoid to make sure you can qualify for the best loan possible and ultimately close on the house that you want?
yeah. Well, the first response to that, which might seem like a completely obvious thing, but talk with the lender first. Because there's some people I think that like we just this is a house we want and we're gonna put it in offer, and it's like, well, can you afford it, and what somebody thinks they can afford and what actually our requirements are could be two totally different things, right? So just making sure you talk to the lender to figure out how much you can afford, see if it, and also I think the thing that's important is when we say can you afford it, when we're looking at a debt to income ratio, uh, most often it would be at 43%, right? Well, we might say, oh yeah, well that works. Like you're qualified, but then you look at your lifestyle and the other things you do, right? You go out to a basketball game, or you go out to a play, or you go grab drinks
Maybe
with a
you even
friend, or
save for
whatever.
retirement.
Yeah, and it's one of those where it may not make sense for you, even though you thought, well, yeah, we can afford this, right? So, and so I think it's just important to do that and maybe sit down with their financial advisor and see what they think, right? Um, and then the other thing too is make sure you check your credit score, right? Because a lot of people, busy with their kids and busy with other things, and may have not realized, oh my gosh, I forgot a payment on something, and you know, uh, you know, messed up their credit. Now they're gonna have to build it back up. And so, make sure you check it ahead of time, not a week or two, but if you have something in the mind, hey, in the next year we want to look to buy something, check it every couple months. Make sure there's not something that happened, because I'd hate to have it happen where you're ready to buy, go talk to your lender, and they say, oh, yeah, this isn't happening. So just be cautious of that. And then Rochelle, I think you mentioned it earlier, but or maybe it was Corey, I can't remember which one of you, but talking about finding the right agent, like I said earlier about finding the right lender, make sure you find an agent that is familiar with the area that you're looking in. If you are that physician, maybe they've had more experience with working with physicians that are relocating. Like I worked with a girl that did that, and she would go pick them up at the airport because they were finishing their schooling. It's like find somebody that really is educated and really understands the whole picture of what you're looking to do, because there's plenty of realtors out there that that are, I'll just leave it at that. They're good. They're good with it.
There's a good recent
Oh,
South Park episode about that. Where, anyways, yeah, I would say my order of operations would be, like you said, talk to your financial advisor first to see what you can afford, because the bank will approve you for more than we would approve you for. Then
yeah.
talk to the mortgage person, get pre-approved, have the mortgage person refer you to a real estate agent if, it's in the same local area, because again, they'll be familiar with each other and play nice together, and it'll go smoother that way. And then go house shopping.
There you go.
Casey, when you're talking about credit and stuff like that, are there minimum credit scores that people should be looking to build? And if it's lower than that, what are some ways that they could potentially improve their credit?
Yeah, definitely. Yeah, always a minimum score. So for, again, this is just specific to U.S. Bank, can be different for other lenders, but for us, the typical score would be 710, right? Now, when loans exceed a million, it does require a little higher score of 720, 10 points higher. So not a huge difference. But as far as, some type of tips, if you are struggling and need to figure out a way to increase your credit, I have to share a story with my best friend. It's probably, I don't know, 10 years ago. And I wasn't even in mortgage at that point. I was a personal banker for 7 years. So, or 6 years, excuse me. So total of 13 years at the bank, right? And when I was a banker, I was talking to my best friend, and he was talking about his credit score, and I think it was 680, 660, 680, something like that, which still, that on a grade scale, you might put it at like a C minus, but that would still qualify you for most mortgages. But I had told him, I said, how much do you have? I know I said this personal question, but I was like, how much do you have as far as a limit on your credit card? And he only had one card. I think it was $1,000, right? And he had a $500 balance on it. And I said, oh my gosh, I was like, you know why your score's down is, I said, because your utilization is 50%, right? And so 35%, or excuse me, 30% of your overall credit score is utilization, right? And so the industry average always, there will always say, is you don't typically want to be any higher than 30%, right? So I said, go call the bank. And I said, ask him for a credit increase. He had started a job that was paying him a little bit more. And so he was able to, to give him that information. And I think it increased him up to like $10,000. So he went from a 50% utilization to, is my math right? 5%?
5%.
Yeah.
Yeah.
And his score in the next month skyrocketed. Right. So that is absolutely the easiest step if you have some, balance on your card, is to just increase it. Now, obviously, if you do have some and you already have a higher limit, then the goal would be, maybe before you buy that house, get that some of that debt paid down to where you get a little bit more favorable debt to credit percentage, right? Because like I said, 30% is the debt to credit, 35% is your payment history, but you really can't do anything about payment history. If you had a late payment, you just got to let time go by, and unfortunately, it's about 7 years before that drops off. So, if you had a boo boo, well, just don't do it again and move on, right? Um, and then the other pieces of the makeup is 15% length of history. You can't really make credit be longer except for letting time go by. uh, the types is 10%. So like if you have a car loan, you have a student loan, you have a credit card, the more diversified that you can be with your credit, it shows the credit companies that you can handle different types of payments monthly, right? And then inquiries is 10%. So don't do a bunch of different inquiries if you don't have to. And kind of a little off topic of way to increase your credit, but comment about the inquiries. A lot of people ask about, oh, should I, I don't want to go to 3 different mortgage companies because my credit's just going to get, hammered. As long as those inquiries are within, the same month, and it's mortgage inquiries, the credit company understands that people are going to go out and shop. And so I get that question a lot is, well, I don't know if I should have my credit pulled. It's like, well, to get qualified, I mean, you have to, right? But if you've already gone to 2 other places, I typically tell them, don't worry about it. It's not going to harm you as much as you may think. And again, it's only 10% of your score. So,
Yeah. We always tell people just not to spread that out too much. Like you don't want to
yeah,
like do one bank one month, and then another bank the next month, and then another bank the next month.
yep, yep.
Have you seen any home purchases or I guess loans derailed by something the borrower did? And I guess so. What's the list of what not to do? What should you avoid doing if you're applying and trying to purchase and close on a home?
Yeah, I mean, I think for the most part, we all could have a pretty good guess on what it would be, but don't go buy that new furniture before your house is or your loan is done and put it on your credit card, right? Because what happens is, the credit report is good for 90 days from the day that we start the pre-approval process, right? But if, let's say it took you 60 days to, or let's say 65 days to find a house, you do a 30-day close, well, they're going to have to pull a credit 5 days before closing because that credit report would have expired. And if you went out and spent money on new furniture and, added a $200 a month, payment to your debts, that could kick you out of being qualified. I personally have not had that happen, and I always appreciate clients that will reach out and say, "Hey, I'm going to go do this. Will it be an issue?" And most often I haven't had that happen. But that was one. The other thing, which isn't as necessarily a huge deal, but it's something that would be ideal not to, is try not to switch a job in the middle of a you know of a loan approval. I actually have a client that is closing tomorrow on their loan, and he was talking about switching. Um, but I told her, I said, if it's not something that you have to absolutely do, let's try to hold it off, because then we have to get a contract from the employer, and then we have to reach out and get the verification of employment, and then again, not just a little bit more work, but that would just be something I would say try to avoid if you can. Um, but as far as anything else, fortunately, I haven't
I
had
think
any,
one thing that,
horror stories.
yeah, one thing I think about with our clients is like thinking about refinancing student loans, because that comes up a lot for people, not so much in the last couple of years, but a refinance student loan payment can be huge. So
Yeah,
definitely not something we encourage people to do at the same time. It's like,
sure.
you do one, then you do the other. Don't do them both at the same
Sure. And actually, one thing I want to bring up that I'm really glad you made a comment about student loans, Rochelle, is
time.
as we heard yesterday, I believe,
Yep.
they're extending the forbearance until August,
End of
I
August.
think,
Yeah.
end of August. Yeah. But one thing that's important to know right now, and this just would be for prospective buyers, basically from now and until that point, and who knows, it may get extended again, but a lot of people that I've had to deal with in the last 2 years because of that don't really think about the payment. So let's just say you had two different loans for $20,000, and when I talked to you and was asking about, okay, what payments do you have? Because I like to verbally pre-qualify somebody, say, okay, how much do you make? Okay, if this is your mortgage payment, this is a dollar amount. How much your student loans, how much your car loans, right? I like to do that before they apply, and a lot of clients will say, oh, yeah, I don't have any. And then come to find out when I pull their credit, they do. And I think they're thinking in their mind, oh, I don't have any because I'm not paying on it right now, right? Well, what happens is when we're qualifying them from the lender standpoint, if it shows $0 on their credit report, we're going to hit them with a 2% repayment, right? So if you're looking at two loans for $20,000, that's $400 a month each a month, right? And that could completely kick them out of being qualified, right? So the way we can get around that is if they're able to reach out to that lender and show what the payment would be when it comes out of forbearance, then we're able to use that. And a lot of times it's a lot lower. It may be, $125 on each. So you're talking about $250 instead of, 800. But I think that's a really important thing right now for people to know is, we got to count the student loan debt payments if they're not reporting on the bureau. So that makes sense.
Absolutely. They still exist. You still have to make those payments at some
Yeah,
point.
yeah, yeah.
Then I guess I know every lender is going to be different, but there a maximum amount that doctors can finance through the doctor program?
Yeah, great question. So with that 10% down, like I said, which with us is the lowest we have available, the maximum loan amount that we will do, not purchase price, but the maximum loan amount with 10% down would be 1 million. And then uh, once it exceeds that at 15% down, which would still avoid mortgage insurance with the product, 1.5. Right. And then after that, basically anything 1.5 and above would require the 20%. So,
Casey, is there anything that we didn't ask about that you think would be good for the listeners to know?
I think you pretty much covered it. Oh, the one comment that you had made, again, not really related to physician loans, but I think Corey had brought up something about lots, right? We were talking about the new construction, all that stuff. Um, US Bank does offer lot loan financing, right? So if you ever have a client that is just looking for purchasing bare land, it's not anything related to using the physician loan product, but with how the market is with inventory right now, I've actually had a lot of clients lately that are just purchasing land, and then we'll look into building on that with typically within the next 3 years or so. So low inventory, it's something that could just be beneficial. Hold on to it for a little bit, and then when stuff potentially cools down, you start to build that, maybe that dream home on it. But other than that, I think like Corey said, I mean, I said I can lend in all states other than uh, New York for purchases and Texas for refinances, but I've done loans in Colorado, Virginia, Florida, uh, South Carolina. So I have a lot of experience in that, and I think it's important because there's different rules in different states too. So again, going back to somebody that knows what they're doing in regards to the lender is an important piece, and yeah, just being available. I mean, that's the thing I tell my clients is, right now I don't have kids, and so if there's ever, they need to call me on the weekend, they need to call me at 9 o'clock at night, I'm happy to answer it if they're on the East Coast, or they're in Hawaii, I don't care when it is. I'm going to get back to you as soon as I can because it's a tough market and time is of the essence. So
I think one thing worth bringing up, whether it's U.S. Bank or any lender, you can't just like call them up or walk into your local branch and say, "Hey, I'm a doctor. I want to get a mortgage with your doctor mortgages." They're like, "Okay." They'll look at you like, "Okay, yeah, we give doctors mortgages all the time." Like most likely, they're not going to be familiar with that doctor-specific loan program. So you need to find that individual human at the bank who is familiar with the doctor mortgage program. Um, it's maybe not quite as hard as finding a needle in a haystack, but at a large institution like the big banks, it kind of is similar to that if you're just calling cold. So, helpful to whether it's the internet or, resources like Rochelle and I, we've got contacts at a lot of different institutions that are familiar with that doctor loan program. And because otherwise you're not going to get the same treatment probably.
yeah, definitely.
Well, thanks for joining
Thanks for
us.
coming on, Casey. Yeah.
Oh yeah, like I said, I appreciate the opportunity, and obviously, if any of your clients have questions, happy to help answer. And if not, just glad we are finally able to get this done after 2 years. So
There we go. All right. Well, have a good one.